Well, next up, we put up the spotlight on the global commodity market. The World Bank's latest projections forecast commodity prices to hit a 4-year high this year. According to its latest outlook, prices of some key commodities could rise as much as 25%. As geopolitical tensions disrupt key supply chains, the World Bank's broad commodity price index is expected to rise about 16% this year. That marks the first annual increase since the post-Ukraine war surge. Energy markets are leading the rally, with prices forecast to climb roughly 24% this year. Brent crude is now expected to average significantly higher than earlier projections, reflecting persistent supply constraints. However, the impact extends far beyond oil. Natural gas markets have tightened, particularly in regions dependent on West Asian flows. Fertilizer prices are also expected to surge by over 30%, driven by higher input costs and supply disruptions. This in turn is likely to spill over into agricultural markets, pushing up food prices globally and increasing volatility in staples such as wheat, rice, and corn. Industrial metals are also facing an upward pressure. Disruptions in shipping routes and higher energy costs are now raising the production and transportation expenses for metals like aluminium and copper, which are critical for construction and manufacturing. As a result, sectors ranging from infrastructure to electronics may see cost escalations. The global economic implications are uneven. Commodity exporting nations like Canada stand to gain the most. Oil-rich economies in West Asia may benefit from higher prices, but sustained disruptions and attacks on key oil and gas infra may not necessarily improve their fiscal balances. Fertilizer-producing countries like Russia are expected to gain a windfall as demand intensifies. On the other hand, import-dependent economies are likely to face headwinds. Countries across Asia and Europe are expected to experience rising input costs, worsening trade balances, and renewed inflationary pressures. Food importing countries are particularly vulnerable as higher fertilizer costs threaten agricultural output and affordability. The World Bank has noted in its remarks that the effects of the conflict are now expected to unfold in stages. For India, the outlook is especially challenging. As one of the world's largest importers of crude oil, India faces elevated energy bills, which could widen its current account deficit and strain public finances. Higher fertilizer prices may increase subsidy burdens, while rising global food prices could complicate efforts to manage domestic inflation. Although some sectors, such as metals and exports linked to global demand, may see marginal benefits, the overall impact is likely to tilt negative for macroeconomic policies.